What happens when a government borrows so much that it can't raise taxes enough to pay it back? But it also can't lower its own interest rates without risking runaway inflation? Because there's a playbook for this, and the US has used it before. Today I'm going to show you the 1940s playbook, the one that basically forces the central bank and the government to move as a team. And I'll explain why people are suddenly talking about a new Treasury, Fed agreement, and what that could mean for the dollar, inflation, Treasury yields, and asset prices like stocks and real estate. There are only 4 ways a country can reduce its debt compared to the size of its economy, its debt-to-GDP ratio. 1. Run a budget surplus, spend less than you collect, and pay the debt down. 2. Default don't pay. 3. Grow the economy faster than the debt. 4. Inflate the debt away, make the dollars you repay with less valuable over time. And guess which option is politically the easiest? Yeah, number 4. But everyone pays for it through higher prices. When debt gets massive, even small changes in interest rates become painful because servicing the debt gets expensive fast. But if the central bank tries to help by pushing rates too low, markets can respond by demanding higher yields on long-term government bonds to compensate for inflation risk. Translation: the government wants cheap financing, and the bond market says, fine, then I want protection from inflation. Remember, this content is for educational purposes only and does not constitute financial advice. The central bank directly controls the very short end of the curve, overnight rates, and the front of the yield curve. But long-term rates, 10, 20, 30-year Treasury yields, are heavily influenced by markets, investors buying and selling bonds based on growth and inflation expectations. After World War II, the US needed to borrow huge amounts of money. So the Fed helped the Treasury by doing something extreme: yield curve control. That means the Fed doesn't just influence short-term rates, it sets ceilings on rates across the curve. And if yields try to rise above those ceilings, the Fed buys treasuries, potentially in unlimited amounts, to force yields back down. Here's the catch: if you're willing to buy unlimited bonds to cap yields, you can end up expanding the money supply and fueling inflation pressure. And historically, that's exactly the risk. Rate caps can look great until inflation starts biting. In 1951, the Treasury and the Fed made what's now called the Treasury Fed Accord, basically a reset of how they coordinate debt financing and monetary policy. And today, markets are debating whether a modern version of that coordination is coming back, just updated for today's debt levels. In 2020 and 2021, the Fed didn't officially announce yield curve control, but it did massive quantitative easing, buying huge amounts of treasuries and other assets. The effect looked similar. Yields fell sharply, and the Fed's balance sheet exploded. Then inflation surged, and the Fed reversed course, raising rates and shrinking its balance sheet. If this story feels familiar, yeah, that's the point. If the goal is to keep Treasury financing stable without long-term yields spiking, someone has to be a consistent buyer of government bonds. One of the most talked about mechanisms is the banking system, because banks can absorb treasuries at scale. But bank rules can limit how many treasuries they're allowed to hold. So if regulators loosen those constraints, banks can become the shock absorber for the treasury market, supporting demand and helping keep yields from rising too fast. If the system shifts toward financing government debt at rates below inflation, it can quietly reduce the debt burden over time. But it isn't free. It often shows up as higher prices and weaker purchasing power. And it can also push money into assets, stocks, real estate, anything that feels like a hedge, because liquidity has to go somewhere. So when you hear people talk about a new Treasury, Fed agreement, it's not just some boring policy document. It's a potential shift in the entire system: how debt gets financed, how rates get managed, and who pays the hidden cost. If you want, I'll make a follow-up breaking down 3 scenarios for the next 12 to 24 months and what each one means for the dollar, treasuries, stocks, gold, and real estate.